data for PepsiCo that I pulled from Nasdaq. Here we can see their trailing 12 months price per share. We can see their dividend price per share per quarter, and we can also see their annual diluted EPS, earnings per share. So diluted EPS basically calculates a company's EPS if all convertible securities were to be converted. So dilutive securities aren't common stock actually, but they're instead securities that could be converted into common stock. So for EPS, it basically shows a worst case scenario, and diluted EPS is therefore considered a conservative metric. So I made sure to use that for this financial table. And a bit below here, we can also see their earnings per share payout ratio, and that's basically how much of their diluted EPS they pay out as a dividend. And we can see here that it's around 10 to 20% in that range somewhere for the most part of the years.
So why exactly is PepsiCo a suitable candidate for the DCF analysis? Well, they do pay a dividend, but we can see from their income statement that their earnings are much different from the dividends that they actually pay. Meaning they have a lot of earnings left over after paying dividends that they can use to pay off other expenses, such as capital expenditures or interests. So, what even is a DCF model? Well, DCF stands for discounted cash flow. And what you do is you basically look at a company's future cash flows and you discount them at the right cost of capital. And in our case, we're going to use revenues and net income to be able to later on forecast the future free cash flow of PepsiCo. So you might have noticed I said free cash flow. Well, what exactly does free cash flow mean? Free cash flow is the cash flow that is available to all of the security holders of the company, both the debt holders and the equity holders. And this is the cash flow that is available to them after having accounted for cash outflows to maintain the company's assets, such as capital expenditures. Free cash flow to equity includes the impact of leverage because it subtracts interest and amortization payments to the debt holders. Remember, interest payments and principal payments are reserved for the debt holders because they have priority over the equity holders as well. So the equity holders can't really expect any of the cash that are reserved to the debt holders. And that is why it is not included in the calculation of the free cash flow to equity.
Even with well-established companies, it's tough to accurately predict operating costs beyond 1 or 2 years in the future. This is why you have to be very careful when applying a DCF valuation. However, though, with Pepsi, we have a lot of analysts covering it, and they don't merely look at past forecast earnings, but they go into company-specific details to have the most accurate forecast possible. As I will discuss more later on, the main weak point of the DCF valuation method is the amount of assumptions made in the calculations. Having said that, this is still, in my opinion, one of the better valuation methods to use for this specific company. If you just look here for a little bit, ignoring all of the numbers over here, you can see that we have two different formulas for free cash flow to equity. The simple formula does not have net borrowings in it. In the clean formula, we have to add net borrowings because this debt is theoretically available as free cash flow to the equity holders, but not the firm. Net borrowings is not available to debt holders because it is not free for them, in the sense that most corporate bonds will not allow you to repay principal until maturity, leaving net borrowings only available to equity holders, because the firm can directly choose to pay it out as dividends, for example. This is why we add net borrowings when calculating free cash flow to equity, but not free cash flow to the firm. Though in this case, we are actually going to stay on the conservative side and leave out net debt. The main reasoning behind this is that it turns out that it's very hard actually to estimate when a company is going to issue new debt. And for this reason, we leave debt out. And this is actually how many analysts do it when they are computing a DCF in reality. For forecasting the free cash flow to equity in the future coming years, we want to see how big the free cash flow to equity has been in relation to net income. And since we can just pull the net income off of the income statement, and we have also calculated the free cash flow to equity, which we did in the step before, we can now just go ahead and divide the free cash flow to equity with the net income. And we can see how big the free cash flow to equity has been in relation to net income for the past 5 years. What we want to do now is that we want to calculate the average free cash flow to equity, or the free cash flow to equity margin average over the past 5 years. And we simply do this by taking the average of these numbers right here, of course. That there's a lot of information right here, but I want you to just specifically focus on this table right here. And more specifically, I want you to focus on these two numbers right here. Because as you can see, this is the total revenue for PepsiCo the past 5 years, which I have simply pulled from the income statement. But these two numbers here are future estimates for the total revenue for each of these years. And how have I got these? Well, actually, there's a really neat trick that I recommend you to do. So basically, you can just go into Yahoo Finance, and then you can search for your stock that you want to analyze. And then we can just head over right here to analysis. And we can actually see here that there are 16 analysts currently covering the revenue estimate for the year 2020 and the year 2021. And so PepsiCo has an average estimate of total revenue of 67 billion US dollars for the current year and 70 billion for the next year. And so I actually just went ahead and pulled those numbers right in here. And the neat thing right now is that we can actually just take the average of these or the average revenue growth rate of these total revenues to arrive at the even later years, 2022 and 2023. So you can see here that for all of these years, the average revenue growth rate is 1.9%. We are going to use that number to calculate the total revenue for 2022 and 2023. So now we have all of this total revenue complete. And now we're soon going to get back to the free cash flow to equity margin, which we calculated before. Don't worry, just bear with me here. And now I just want us to head over to the net income. Because as you can see here, we have the net income of the past 5 years right here. And we can actually just go ahead and calculate the net income margin, which is basically the net income divided by the total revenue right here. And if we take the average of the net income margin for the past 5 years, we arrive at a number of 11%. We're simply going to use that number for the coming 4 years. However, during the corona pandemic, I actually wanted to be a bit on the conservative side, as I don't really believe that the income margin will be that high for this year. And so I for this year I actually went ahead and had a little bit of a lower number there. I put 7% instead of 11%. But then, as I expect Pepsi to arrive back from the crisis to normal terms, we use 11% for all of the other coming years. But that's a good footnote that that is why it says 7% here and not 11%. All right, so if we just continue, now we almost have all of what we need. The final thing here is that we're going to arrive back, as I said, to the free cash flow to equity margin, because right here, as you can see, the only thing that we've done is that we've multiplied the average free cash flow to equity margin by the net income, which we now have. And then we can finally arrive at the free cash flow to equity, not only for these 2 years, but also for 2022 and 2023. As you can see here, D29, which is this little cell right here. Yes. All right, so let us just go ahead and pull those numbers in here in our DCF valuation spreadsheet table right here. And then the next step from here is actually to determine the discount factor that we have. And it's actually pretty interesting. Since we're calculating the cash flows to equity, we need to use the appropriate discount rate. And discounting cash flows to equity with the weighted average cost of capital will actually lead to an upwardly biased estimate of the value of equity, because the cost of capital is generally lower than the cost of equity. So if you average those costs out, you will ultimately discount the cash flows with a lower discount factor, in turn leading to a higher skewed value of equity, which we of course don't want. And so the appropriate discount rate for us to use is the equity cost of capital. And so by the standards of CAPM, the capital asset pricing model, which I'm not going to go into detail right now, this is the way we calculate the cost of equity. And continuing from here, we actually need to determine a risk-free interest rate that is appropriate for the duration of our future cash flows. And generally, when doing a DCF, usually the 10-year Treasury bond is accepted as the risk-free rate. And so it is not appropriate to, for example, use a 3-month Treasury bond, because it doesn't account for the cash flow duration period. So that is, in case you wonder why the cash flow, why we are using the 10-year Treasury bond and not the 3 months, for example, because we are discounting several years, not just for a short time span. And so continuing from here, we can actually go and head back to Yahoo finance charts right here, and we can actually go ahead and search for the 10-year Treasury yield. And we can see that if we head over to historical data, and we simply, let's choose a period here of let's say 1970. So I'm going to go way back right here, just so we can get a really deep overview of how the Treasury yield has been over the last couple of decades, actually. And this is super interesting, because you can see here that if we go all the way back to let's go all the way back to, and so I'm looking at the adjusted price, adjusted for stock splits, right here. And we can go all the way back here to the 90s, to the 80s, And you can see that the treasury yield has not been anywhere near where it is now. We have actually reached unprecedented times. It has never been this low ever. So this is super, super special. And of course, it is because of the corona pandemic. Because what has happened actually is that the price of the treasury bond and the historically low prices, I mean, this has never happened. This indicates to us that there's a surge in demand for treasury bills because people seek for the safer alternative to stocks, as huge uncertainty and risk is prevalent on the stock market right now. And so we are still going to use the current price of the treasury yield. And this is also super important because I want to point out that we cannot simply ignore the changes on the market with the argument that our parameters will soon be back to normal long-term values. This is because the changes to market risk premium and beta are fundamentally driven, and they reflect new projections on the performance of company and increased uncertainty on the market. So, for example, if our model implies a market risk premium of 11%, which would be a fairly good guess, since when there's a lot of risk on the market and a lot of volatility, the market risk premium usually goes up. Of course, investors require more return on their money than they did before. And this is not only a one period risk premium, but this is rather the average market risk premium over the whole discounting period. So that is why it's so important to actually have your parameters up to date, because remember, we do actually expect our parameters. For example, beta is also really has really special value right now, and as does the market risk premium. And these parameters, we do expect them to return to their long-term averages, but this does not help us at all, since we're doing a valuation of a single business, of PepsiCo at present time. We're not doing a valuation of their future fair value. So it's super important to remember to always bring the parameters up to date. We cannot use just long-term values for all of our parameters all the time. Hence, we have to stay up to date. There's actually a famous investor that once said, I don't remember who it is, but he said, "You don't want to be the 6-foot man who drowned crossing a river who was 5 feet deep, on average." So I thought that was quite funny. But all right, so enough of that. Let's actually go back here and see what we need now. All right, so we just got our risk-free rate, which was 0.68% from the 10-year treasury bond. And we now need the beta for the stock, which in this case is PepsiCo, and we also need to multiply that with the market risk premium, which is basically the expected return on the market minus the risk-free rate. So if we just go ahead and start with our beta. So let's just keep using this fantastic statistical site, and we can just head over to PEP. The ticker symbol is PEP for PepsiCo, which one of my colleagues, Shirley, already has stated out. So let's just head over here to statistics, and if we scroll down here, right here under stock price history, we can actually see that the beta, the average beta, so what they have done is they have gone back 5 years, and they have taken the monthly beta for each and every month, going back the past 5 years, and then they've calculated the average beta out of all of those monthly betas, basically, and it turns out it's 0.61 right now. And so, of course, this is constantly updated every month. So we have our beta of 0.61. And let's let's check if what do we need now? Well, we have our beta now, and all that is left actually to calculate our cost of equity is the market expected return of the market, or the expected return of the market. So if we just head over, just 1 second, let's just head over here, because I have done some research, and it turns out that right here. So I went to Investopedia, which is a great, reliable source for financial information, and here it says that the average annual return since the S&P originally began almost 95 years ago or something like that, is approximately 10 to 11%. And since the adopting of the 500 stocks, because before it was just 90 stocks, since they adopted 500 stocks in 1957, it has been roughly 8% annually in returns. And so what I think is reasonable to do right now, and this is my own personal opinion, and you could go into theory, I guess, and do a much more complicated derivation of our expected rate of return. But to be completely honest, that actually makes difference on the marginal. It's not that important for our model, to be completely honest, since the difference won't be that much in the end if we use 10 or 9% for the expected return on the market. But right now, the expected return of 2020, I think, is going to be a lot lower than average. What we just have to remember right now is what does this actually mean in the formula for the cost of equity right here? Well, this right here, after our beta, and by the way, I maybe forgot to say that beforehand, but beta is basically how the stock relates to the market. So think of it as if the S&P 500, or the market in short, if the market goes up by 1%, how much of a change would that relate to in the stock? So if the market goes up 10%, and our stock has a correlation of 0.8, it means that our stock goes up 8%, and so that's essentially what the beta says here. And this right here is the market risk premium, and we have to remember that I've actually done some research, and after having read a lot what different analysts have to say, the fact and the case is actually that, perhaps not too surprisingly, it's quite obvious if you think about it, but the market risk premium, as you can see here, goes up in times of volatility on the market, in times of huge risk on the market. The market risk premium goes up, of course, because if you as an investor are going to take on much more risk, well, then obviously you want a greater return on equity on your investment. So that's actually not too weird there. But yeah, so let's actually see here what it says. Well, in Europe, this graph shows us that on average, the market risk premium, which you can see is the black bolded line right here, see that as they say here, they can see steep increase in March 2020 to a value of the market risk premium of 11.2% according to the model. And we're actually going to go ahead for our model and use 11%, which is slightly higher than the otherwise long-term average market risk premium, basically. So basically, what we're going to do is we're going to do a small calculation right here. So we're going to have return on equity equals 0.68 plus 0.65 as our beta was, times 11%. Can't have that, so we do like this. Perfect. 7.83% for the cost of equity. If we were to invest in PepsiCo right now, what would our required return be for the stock? And it would be 7.83%. And this is really neat because the only thing we're going to do right now is we're going to use this number right here, our cost of equity, and we're going to use that to arrive at our discount factor, which in turn is going to lead us to the present values of the future cash flows to equity. So let's just go ahead and copy this cell right here in here. So 7.83% is the required return for us with the current market parameters that are, of course, up to date. So let's just go ahead and make this cell a percentage point, and all of these. Well, of course, we're not going to discount the previous years, and so the years that we actually are going to discount, we can simply go ahead and format them as number cells. Perfect. So what we're going to do right now is for the first year, 2020, which is our first year that we're going to discount, we can simply make that equal to 1 plus our required return. And the discount factor is, of course, 1.0783. And to arrive at the later the other discount factors for the later years, we can simply take this and multiply it by 1 plus our required return. We can go ahead and put this in dollar signs right here, which is essentially telling Excel to fix this cell, the required return. And turns out this is for the year 2021 for the expected free cash flow to equity is $6,015, and our discount factor is 1.1627. We can just go ahead and drag this formula out here for the other years, and it's going to work perfectly because this cell right here takes the previous year's discount factor and compounds it by our required return or cost of equity. And so perfect. Now we have the discount factor for all of the years. Well, let's just go ahead then and make the easiest step of them all, and that is to divide the free cash flow to equity by the discount factor. And this gets us, of course, the present value of the future cash flows. Now we just need to find out how many shares outstanding PepsiCo actually has at the current time. And we're going to do this by looking at Yahoo Finance. Could start by actually going back to Yahoo Finance and checking. If we go down to statistics, let's see if I just outstand 1.39 billion. All right, that seems a bit vague, so I'm just going to double check on that. So what we will do is actually bring up the annual report. Or actually, let's search for Pepsi. Oh, there we have it. PepsiCo annual report for 2019. And if I bring this over here, we can just do like this. We can just search for common shares outstanding. Page 12. Oh, here. The number of shares of PepsiCo Inc. common stock outstanding as of February 6, 2020 was 1.389 billion shares, which is very close to what Yahoo Finance told us actually. So that's perfect. So we're just going to go ahead and use the more specific shares outstanding number, which is the one that we found in the annual report, as you just saw here. So 1.389 billion. Let's just go ahead and use that. So we're almost done here. Let's continue with calculating our perpetual growth rate, which you can see right here. And the perpetual growth rate for the free cash flow to equity actually tells us on average how much the free cash flows to equity are going to grow each year. And my favorite factor or percentage to use for this is actually 2.5%. And this basically tells us that in perpetuity, the free cash flows to equity are going to grow on average at a rate of 2%, 2.5% annually. And the key here is to use a perpetual growth rate that is actually in line with the current, or not just the current, that is in line with the long-term market. And so we can't use too high of a number here, because let's imagine that I decided to use a perpetual growth rate of 4%, and at the same time the market is growing in perpetuity at a rate of 3%. Well, that would imply that eventually our stock, PepsiCo, is going to be larger than the market economy. And that just isn't plausible at all for obvious reasons. And so we are staying a bit on the conservative side here, if I would say so myself, by using 2.5%. And this number is in line with the current, or sorry, not the current. This number is in line with the long-term market and the history of the market. And so what we just need to do now is, when we actually have our perpetual growth rate, is, well, you might have noticed that it says terminal value here. And well, what does this mean? Well, we can't keep discounting manually forever, of course, and discounting every future year, the free cash flow to equity for every future year in eternity. Well, we can actually use a mathematical perpetuity formula to arrive at the value of the free cash flow to equity for all of the future cash flows. Went ahead and pulled up the mathematical formula for a perpetuity. And I'm not going to go too much into detail of why it looks like it does. It can be found in most corporate finance books, including the one from Peter DeMarso and Jonathan Burke. But essentially, we have our free cash flow in 2023, and we multiply that by 1 plus our perpetual growth rate. And as you can surely figure out, this will then be our free cash flow to equity at the next period. That is the year 2024. And so that is actually how the mathematical formula looks. You take the cash flow of the next year and divide it by the market growth rate minus the growth rate for your stock, and that is your perpetuity of the value of that year for all of the coming. That is the perpetuity value, in short. And so the reason you subtract 2.5% here in the denominator is because, as I said before, the free cash flows to equity grow by this percentage every annually, and thus subtracting it in the denominator will make us have the right perpetuity value. And so remember, this is the terminal value at time period 2023. So actually, in order to get to the present value of the future terminal value, we have to discount it by the right discount factor. And remember, even though our cash flow right up here is the cash flow from the starting the next year, the terminal value is actually of the same time period as 2023. So this is the terminal value of 2023, not the terminal value of 2024 like the cash flow is. This is the cash flow of year 2024. So that is a distinction that I just felt it's quite good to just put that out there so we don't have any misconceptions about what we're actually doing right here. And so we just need to go ahead and let's see. So sorry, as I said, we're going to use the same. So let's just copy this 1.3519. Perfect. And then we simply divide this by the discount factor, and let's make this a little bit more smoother. So I'll go into number, I'll remove the decimal places, or actually currency, sorry. I don't want any symbol there. So all right, looks much better already. So this is the present value of the future cash flow. And what we can actually do now in order to get to today's value is that we just sum up all of the future cash flows at a present value, which we have calculated. So this is in short equal to the sum of, let's see, F6, right? Let's actually do G6. No, sorry. H6. H6 to 6. Number is quite big to grasp in your head, but it's $126,411 million. And if we just go ahead and put in the shares outstanding, which is 1.389. Missing one. Perfect. So 1.389 billion, right? And to arrive at our fair value of equity, we simply need to do one last thing, and that is simply to divide let's just put this in dollar terms, because we want to have our fair value of equity for the dollar per share, so we can compare it to the current PPS of PepsiCo. So as I said, this was today's value of $126,411 million, and since it's in millions, we can just simply multiply it by a million and we will have it in dollar terms. So this is in dollar terms, and if we just go ahead and divide today's value with our shares outstanding, we will arrive at a fair value of $91.008, roughly speaking. And so, well, what does this value tell us? It says us that the fair intrinsic value of PepsiCo is $91.778, roughly speaking, according to our DCF valuation method. We can actually go back to Yahoo Finance one last time to check the Pepsi stock and compare it to the fair value we got with the analyst's fair value. And you can see here that if I try to zoom in here, if I just try to zoom in here, right here, you can see that the fair value that the analysts have gotten is also indicating that at the current share price of roughly $133, the stock is currently overvalued, which is actually in line with the result that we got. And so I think it's important also to not base your investment decision solely on the DCF outcome, but rather take it with a grain of salt and use it as a guidance when doing your investment decision. But either way, this is our results, and that was the DCF valuation method, and I hope that you've enjoyed each and every single bit of it. So that's my part here. Thank you.